Good day everyone. So we're going to tackle the chapter 13, which is the basic of commercial banking.
You probably know that banks are where you keep your money safe. But did you know that there are also the engines that helps our economy run? First, let's define what is bank. A bank is like a middleman connecting people who have money, depositors, with people who need it, borrowers. They take money from savers and lend it to those who wants to buy a house, starts a business, or just needs some extra cash. Now let's delve into the world of commercial banks, a specific type of bank that we'll be focusing on. So what is a commercial bank? A commercial bank is a special kind of bank that focuses on helping businesses, governments, and individuals with their financial needs. Think of them as a one-stop shop from all of your money-related needs. So, what is the purpose of commercial banks? So, their job is to support the financial needs of everyone around them. They provide a wide range of banking products and services like checking accounts, saving accounts, and loans. So, how do commercial banks get their money? So, they get their money through deposits. Think of your saving accounts or checking account. When you put your money in the bank, it becomes one of their main sources of funds. It's like lending your money to the bank. So, next is how do they use that? So, banks use the money they get from depositors and borrowing to make money themselves. They do this through loans. So, this is how banks makes money. They lend the money they've collected to businesses and people who need it. Loans are made a variety of purposes like buying homes, starting business, or covering personal expenses. Next is let's delve in what are the bank assets, liabilities, and capital. So assets are what the bank owns, like loans they've made, bonds they bought, and their buildings. So liabilities are what the bank owes to others, like money in your checking account or the money they borrowed. So next is the bank capital. Think of the bank capital as the bank's safety net. It's the difference between their assets and liabilities. So it's a caution to protect the bank if things go wrong. So there are different ways to keep your money. So bank offers different type of bank accounts depending on how you want to use your money. First is the demand or the current account. So this is your everybody checking account. You can use right you can write checks or pay a debit card for things. So bank usually don't pay interest in these accounts because the money is readily available for you to use. Non-demand deposits. So these are like saving accounts where you can deposit your money and earn interest, but you can't withdraw it easily because banks use this money for a long-term investment. Next is the borrowings. Sometimes banks need to borrow more money to meet their lending needs or to take advantage of investment opportunities. So they borrow from other banks, the government like Federal Reserve, or other financial institutions. So what assets do commercial banks own? Commercial banks owns a variety of assets that generate income and help them operate. First is the reserve and other cash assets. So banks must keep a portion of their deposits in reserves to meet customers' withdrawals. They also hold cash on hand for daily operations. Securities. Banks investment in bonds, government securities, and other financial instruments to generate income and manage risk. Next is the loans receivables. These are the loans that banks have made to individuals and businesses. Other assets. So these include things like bank buildings, computer systems, and other equipment. So next, let's discuss the risk. Commercial banks also have a few risks in their businesses. First is the liquidity risk. So this is a risk of not having enough cash in hand to pay out the money to customers who wants to withdraw their money. Banks manage this by keeping some of their money in reserve and carefully investing their money. So next is the credit risk. So this is a risk that someone who borrowed money from the bank won't pay it back. Banks reduce this risk by carefully checking a borrower's credit history and requiring collateral, something valuable to use as a security for the loan. Next is the interest rate risk. So this is the risk that interest rates will change. making it more expensive to borrow money or reducing the value of the bank's investments. Banks manage this risk by carefully investing their money and making sure that they have a good mix of investments with the different interest rates.
In continuation with the previous discussion, let's now delve into how compliance with the reserve requirements affects the financial position of a commercial bank. So, compliance with reserve requirements imposed by the Bangko Sentral ng Pilipinas plays a significant impact on the financial position of a commercial bank. So, reserve requirements mandate that banks hold a certain percentage of their deposits as reserves, either in the form of cash in their vaults or as deposits with the BSP. These reserves are not available for lending, which affects a bank's ability to generate income through interest on loans. The higher the reserve requirement, the less money a bank has available to lend, potentially limiting its profitability. Moreover, banks must maintain these reserves at all times, requiring them to manage their liquidity carefully and potentially incurring costs associated with holding excess reserves. Additionally, the need to maintain reserves can lead to higher operating costs for banks, as they may need to adjust their investment strategies or borrow funds to meet the requirements. Now let's have the methods to manage credit risk. Credit risk arises from the possibility of borrowers defaulting on their loan obligations, leading to financial losses for a bank. For credit risk, they assess borrowers' credit worthiness, limits, set limits on loan amounts, require collateral, and diversify their loan portfolio. So flashing on your screen right now is the 6 methods to manage credit risk. Those are diversification investors, credit risk analysis, collateral, credit rationing, monitoring and restrictive covenant, and lastly the long-term business relationship. So these methods helps to manage credit risk. Okay, now let's have the return on assets. So, return on assets for commercial banks is a crucial profitability metric that measures how efficiently a bank utilizes its assets to generate profits. So, in calculating return on assets for commercial banks, it is calculated by dividing the bank's net income by its average total assets at the beginning and end of a specific period. So the higher the return on assets indicates that bank is more effective in converting its assets into profits. Return on equity for commercial banks measures the profitability of a bank in relation to its shareholders' equity. It is calculated by dividing the bank's net income by its average shareholder equity. Shareholder equity represents the value of a bank's assets minus its liabilities, reflecting the amount invested by shareholder. The higher the return on equity indicates that the bank is generating a greater return for its shareholder. Now let's have the management of bank assets. Commercial banks manage their assets strategically to achieve profitability, safety, and liquidity. They diversify their portfolios across various sectors and investment types, including loans, securities, and real estate to mitigate risk. And lastly, we have here the 3 strategy to accomplish this objective of bank. First, banks try to find borrower who will pay high interest rates and will most likely settle their loans on time. Second, banks try to purchase securities with high returns and low risk. And lastly, third, banks manage the liquidity of the assets so that its reserve requirements can be met without incurring huge costs. So these are the 3 strategies in accomplishing or in managing bank asset in order to maintain the stability of the bank. So thank you guys for listening and hope that you have learned something in this video.